shall we? The break-even point I found where returns are very similar is if you could achieve a 14% consistent return, and that would be 14% in our current market for 4 years, change over to a new market and achieve 14% over that next 4-year period.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
Today, I'm answering the question, should you be playing for keeps and holding your properties after a peak high cycle has been through, or should you consider trying to time your sale and selling your properties to move into a upward trending market in another area? So I'm going to try and tackle this from a few different angles. And I want to look at both the pros and cons, as well as initially take you through my assumptions. It might be a shorter episode, but I hope that it's going to hit the mark for quite a few people that are asking themselves this question and might think about it in the years to come as we near out the end of our cycle. So my initial assumptions that I've used is that you're on a 37% tax bracket. If you're on a higher tax bracket, that's only going to tip the scales in favor of holding. If you're on a lower tax bracket, it's probably going to mean that you don't have as high a borrowing capacity because you don't have as high a taxable income. That's probably going to mean that, it tips the scales a little bit more in favor of trying to sell and change over properties into upward trending markets. So 37% tax bracket, that's what the majority of people are on. If it's a higher tax bracket, it's going to certainly be in favor of holding your property and not selling. Next assumption, I've assumed a growth period of 4 years followed by a flat period of 4 years. And why did I choose this? Well, I needed to break it up and I wanted to go off property cycles typically being in a 7 to 10 year cycle. And it also made sense to me when I looked at how those sorts of periods coincided with an overall average growth rate of around 5% per year over a 10-year period. So I also modeled things out at 5% of buying costs, and that's assuming that each time you sell, you have to buy back in and pay 5% stamp duty, settlement agent, and potentially higher if you add a buyer's agent onto this too. So you'd really probably allow for an extra 2% in your buying costs if you're going to involve a buyer's agent. And believe me, if you're trying to sell and buy into different markets, you definitely want to get expertise in that local market to ensure that you succeed, because this selling and buying scenario is very heavily dependent on you achieving the higher returns in the new market that you buy into. And it also assumed a 2.5% selling cost when you're getting out of the asset. So all of these assumptions really lead through to the fact that you're going to have to pay capital gains tax whenever you sell. And if you've held the property for more than a year, you get a 50% reduction in your capital gains tax. So assuming you're on that 37% tax bracket effectively makes the tax you'll pay at 18.5% at your on the gains. And if you look at the difference between the two scenarios, when you're holding, you don't have any taxes, no changeover costs, no selling costs, no buying costs, no hassle because it's set and forget. Other scenario, you're changing over every 4 years, you're paying these buying costs, these selling costs, paying the capital gains tax that you get at a 50% reduction on your marginal tax rate, and you're really hoping that you can achieve those consistent returns in the new market too. So let's go into my findings, shall we? The break-even point I found where returns are very similar is if you could achieve a 14% consistent return, and that would be 14% in our current market for 4 years, change over to a new market and achieve 14% over that next 4-year period. And if you can do that consistently so that you're achieving, an average return of 14% over those 4-year brackets whenever you buy into an area, then that's going to break even to be the same as if you'd achieve the same with a buy and hold strategy over that same period, assuming that you had the growth for 4 years, it was flat for 4 years, growth for 4 years, flat for 4 years, etc. So a pretty high return that you'd need to achieve in order to make the selling strategy well, just to break even, you'd need 14% return. Now, let's say for a moment that the returns that you buy into are less, I'd say 10% for the next 4-year period. At the end of 8 years, you'd actually be 100,000 worse off than after you sold and bought into that next market, as opposed to if you just held over that period. So that's pretty considerable when you also look at, even buying into and getting a 10% return could still be difficult to achieve, let alone a 14% return just to break even. And then obviously you'd need above 14% consistent return over that 4-year period to make it worthwhile and have a greater return. So other factors to consider is the effort involved in transacting is very large. So every time you go through a sale, it's the mental headspace of working out, who you're going to appoint as your selling agent, what's the best time around your lease, is the property presented and at its best, overseeing all that process, appointing your settlement agent, ensuring everything, goes through as planned. And then you've got the effort involved on the purchase side. So you likely need to appoint a buyer's agent. You'd need to go through finding an actual property that's going to stack up and achieve, returns greater than that in all likelihood. It requires you to either know or find the expertise that's familiar with multiple markets and good service providers in each as well. So you need to go and refine that settlement agent. That building inspector can keep the same finance broker, thankfully. You'd need a new property manager. You'd need the new buyer's agent, as if I didn't mention them already. So you've got that extra challenge, if you will, of forming all of those relationships or finding someone that can help you, like a buyer's agent that might be able to open the door to those. Thankfully, that's one way to leverage things. But it's a lot of effort, isn't it? Either way, it's a lot of real effort, a lot of mental effort. So other factors to consider is you've got greater risk on you not only being right about the positive trend of the area that you're buying into, but also the amount of growth, average growth that you're going to get over that 4-year period needing to be high. So to achieve that 14% consistently over a 4-year period, you have to be pretty damn good to choose a suburb and a specific property every time that's going to do that. So it really requires you to time markets, both with the buying and the selling. And in reality, it's very difficult to do that even for the best of us. And the challenge might be as well that, say, if you sold out of Perth in a year or two, or whenever you can see the writing coming on the wall, is there a market for you to buy into straight away that is going to achieve these kind of returns that I'm talking about of 14% plus? And if there isn't, that means sitting on the sidelines waiting. And I haven't factored in waiting and having a further flat period in the selling after you sell, before you buy, and padding out the overall time period is going to lower your overall average return and only make it potentially, having greater risk with the selling and buying approach. So it's for good reason that every successful investor I know is an investor first and foremost, and not a trader of property. And for good reason, they buy and hold, they set and forget, they put things on passive autopilot. And if they are putting the energy in, it's only energy in once to buy property into a market. And that way you're getting the best return on your upfront energy, as well as not needing to, continually go through the hassle of selling, the hassle of rebuilding relationships. And, it's not within everyone's comfort zone to be going into multiple other markets. Many investors do just stick within the one state of where they're familiar and where they're comfortable, where they've got their relationships and where they have their property manager and their buyer's agent they trust, and where they overall feel comfortable and is achievable. Now, I guess the other factor I haven't sort of mentioned here in all of this, which can be difficult as well, is can you redeploy your capital at the same or similar purchase price to what you've sold at? Because if you can't in that scenario and you're priced out of the market, then that's also going to affect the overall returns that you're going to get from buying and selling. And if you find out that you've made a mistake and then decide to rebuy back into the same market, you certainly wouldn't want to do that after just paying all your transaction changeover costs, because you have to reach further into your pocket and be left with less than when you started. And that person that's just passively buying and holding, meanwhile, hasn't gone through any of those hassles, any of that effort, and is just letting their returns compound quietly in the background. So hopefully that goes to answering the question, and I've painted the picture well, both financially and overall with energy and how that might affect your lifestyle and eat into your headspace when approaching each of these things. If you've enjoyed this episode, you have any other real nitty-gritty questions that would take some time to research like this, let me know. I'm going to tackle another one coming up in an episode ahead from a question from one of our listeners. And if you've enjoyed it, share it, like us, review us on Spotify and iTunes. I really appreciate you tuning into the show. Catch you on the next one.